See now, oil, it rose again today. This coming after manufacturing in the Philadelphia region contracted in June at the slowest pace in 9 months. The least bad scenario. It's a sign the economy may be in a position to grow later this year. But what about high oil prices? Which way is oil headed? My first guest today is J.P. Morgan's global head of commodities research and expert in oil and energy, Lawrence Eagles. He joins us. Lawrence, good to have you with us. So what does this mean when we see oil kind of stabilizing around $70 a barrel? Is there a fundamental reason for it to be priced at 70?
The reason the market is at these levels is it is looking to the future. I think the oil market is very much seeing 2 points of tightness. One, in 6 to 9 months' time, when the effect of OPEC cuts has taken full effect and the economic recovery is underway, and we see these excess stocks that we've got worked off. And also in perhaps 3 to 5 years' time, when there's a lot of concern about peak oil. Now, should the market just trade along at a very low level for the next few years or the next 9 months and then suddenly spike higher and then spike higher again? Or should it be looking to ration supply and demand at this precise moment? And I think the market's looking forward to Christmas, to the first quarter, when it sees a much tighter balance between supply, demand and stocks.
Now, is there a possibility, though, that all those wonderful future hopes, those glimmers in the eyes of those who want the price of oil to go up, those speculating perhaps, or even the oil producers, is it possible that what we're really going to get is not much of a party by Christmas? Could they be disappointed?
Well, that's one thing that has concerned me, and I think there are a couple of obvious risks around this. But when you look at oil demand in April and May, it's pretty low. That's the worst point of the recession. It's also the worst seasonal point of oil demand in the year. We always move higher in the second half of the year from the lows in April and May.
In terms of consumption?
In terms of consumption.
Okay.
So we have seasonality in our side. Even if the economy doesn't grow, even if it stays relatively weak, we still have seasonality on our side. But also, we've seen in other industries where you have a destocking taking place. And this is what we're seeing on a global basis. And I think the petrochemical sector, which has already done it, we saw demand fall. The industry didn't really know where things were, so they reduced operating rates to an even lower level. And then they used stocks to fill up the balance. The world has been trying to get rid of its stocks, and as a result of that, world trade has contracted. And once that destocking process is complete, suddenly you're going to have to meet actual demand through industry levels. That means raising your industrial output. That means increasing your trade. That means increasing your oil demand.
So would it be fair to say it's a contrast between almost feeding yourself out of your larder and feeding yourself out of going and buying new food at the grocery store on a regular basis?
Yeah, that's one way to put it.
And having said that, though, is there a huge supply of oil that is waiting for a higher price, that's just sitting in storage somewhere, waiting for someone else to say, okay, I'll give you $75 or $80 a barrel for it?
Absolutely. There is a very large amount of oil in storage. We have probably 160 million barrels of oil in floating storage. We have land-based storage virtually full. But when you add up those numbers, it looks huge, but above what is considered normal, it's 3 days' supply. So it's a relatively finite amount of supply, which can go in the oil market quite quickly. That's not the same in some of the other commodities, but in the oil market, it doesn't necessarily last that long. And we think if things pan out the way we expect, you get rid of the floating storage by the end of this year, and you get rid of your land-based surplus by the end of the first quarter.
So a lot of the money that you're seeing going into a long oil trade right now, they're not looking for something next week, next month, although they'll take it, but they're looking for something maybe even 6 months to a year in the future.
And sometimes even further forward than that. I mean, I think a lot of people are looking at this 3 to 5 year portion and saying, well, we're going to have tightness then because of peak oil. Whether you agree with that or not is a debatable point. But I think the way the market has changed at the moment is it's saying, well, are we actually going to have that? If we're going to have that tightness now, in 5 years' time, we need to have higher prices now to ration demand. And I think the market is adjusting. It could be wrong. It could be very wrong. But
right, we're going to find out. We're going to continue the conversation. There's more to come with J.P. Morgan's Lawrence. This is Taking Stock on Bloomberg. I'm Pim Fox. My guest, Lawrence Eagles. He is the global head of commodities research at J.P. Morgan. Lawrence, we're talking about oil and oil prices, people looking into the future, perhaps to the peak oil theory, to also to demand coming back. What about the future of the election in Iran? How is that affecting oil traders?
It's actually, I think, passed the market completely by at the moment. When everyone talks about Iran, they normally think about nuclear weapons. They worry about the Straits of Hormuz being blocked and all the Middle East oil supplies stopping. Those are horrendous scenarios. But when it boils down to it, we look at Iran and we say, are there going to be any barrels which are going to be stopped by what's happening at the moment? Maybe, if it carries on, but we have seen situations before where essentially the middle classes have been rioting, and I mean, 10 years ago, this just petered out. Everyone got very excited, but nothing happened. And the market learns, and it learns to sit back and wait and see whether there is a threat to barrels. And at the moment, it doesn't see a threat to barrels, so for the oil price, it's not an issue. If things change, it could respond very quickly.
Well, just to give a little detail, if we can, talking about, let's say, oil in relation to Iran, they would like the price, as most oil producers, I would imagine, would like the price to be around $70 or a barrel. What does that do for the finances of countries like Iran, for Nigeria, for Venezuela? Does that boost the strength of the governments there?
Well, higher oil prices are massively important. I think this is a really important point. And in actual fact, it's not just $75 a barrel, which was talked about at the last OPEC meeting, but subsequently we've had oil ministers coming out and saying there's no need to add supplies until we get to $100 a barrel. Now, that's a big shift. Now, whether the market can actually sustain such a rise, that boils back to the economy. But certainly, I think a lot of Arab economies would be very happy, and a lot of OPEC economies very happy with the oil price somewhere around $80 a barrel. That helps them have enough social spending, it helps them grow. And that's certainly a key area that they would like.
Having said that, every time we get these ministers of the OPEC nations together, there always seems to be some subtext to what goes on, particularly coming out of Saudi Arabia. They are perhaps, not as vociferous in their delight for higher oil prices?
Well, that was the case.
That was the
case.
Tense
and
event.
Yeah, exactly. And this was an extremely important change in sentiment at the last meeting, is that Saudi Arabia came back and didn't say prices, we were going to hold prices at 75 or push them to 75, but we hope they're going to get there in the near future. And that is a distinct difference to saying that we need to have lower oil prices to help the world economy on its feet. That was a significant change in policy and politics.
When you looked at the consumption patterns, and you noted earlier that we have this kind of seasonality, particularly when it relates to gasoline consumption in the United States. April, May, typically months where we're not seeing huge consumption. If that number does not improve dramatically, let's say by the end of the year, is there going to be a rethink on the part of OPEC to $75, let's say $75 oil?
I think actually there's two issues here. I think the big seasonality and the demand push is going to be from the heating oil and the diesel and the fuel oil side of things. Gasoline demand's actually been quite strong and above year-ago levels in the US and quite strong around the world generally. And that's because it's a consumer good and it reflects consumer spending. So that's actually quite a positive sign and shows that consumers are spending. But every time we ratchet the price up, it starts to take money out of people's pockets, less money they can spend elsewhere. And this is probably our major concern, is that the higher oil prices are going to chip away at this economic recovery and make it somewhat slower.
And is it possible that we won't get that recovery, or it's going to be elongated? The time frame is going to be much longer because at $70 a barrel, nearing maybe $3 a gallon for gasoline, it's just going to make economic recovery that much more difficult.
I think absolutely. I think it's also the speed at which you get there. I don't think there's a problem going from $50 to $100 a barrel over the course of 2 years, but if you get there in 3 months, that's an issue.
So tell us, what are you telling your clients right now? I mean, is this a good time to be getting long oil slowly?
I think there are a number of issues which we're getting a little bit cautious about. When I was here just a few weeks ago, we thought the price was going higher, but it's got there very quickly, and that worries us. I think short term you could see a bit of a setback, but if the economy still shows signs of picking up and being less bad, as you say, and actually even showing growth, which we're seeing in parts of Asia, then I think we could start to see the market push a little bit higher. But OPEC are saying no more oil till we get to $100 a barrel.
All right, if I can, let me just turn your attention to the natural gas market, if that's likely, because we've seen a run-up in the price of natural gas. We have not seen any fundamental demand statistics that would show that there's a huge amount of industrial or even utility demand for natural gas. What's your take on the price of natural gas, and why is it moving?
I think if you sort of dig deeply enough and look into a microscope, you may see some elements of stronger demand, but you have to look very hard. I think one of the factors which is getting people excited is seeing some announcement from some of the traditional producers that they're actually shutting in wells. And that starts to signal a tightening of the whole process. And it's not just rig counts for future production which is being cut, but it's actual production which is becoming uneconomic. And now they're looking to say, well, where will that come back on? How much more is going to come off? And so people are feeling a little bit cautious, but we still have a lot of supply out there. We still have a lot of competition from LNG. It's not fair to say that everything is over yet.
All right. I want to thank you very much, Lawrence Eagles, coming in from J.P. Morgan, the head of commodity research, giving us your insight into the world of oil and oil prices, as well as a little bit of detail on what's happening in natural gas. Thank you very much.